From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Paul Gigot here with Mary O'Grady and Joe Sternberg, and we're talking about the latest consumer price increase data, which came out today. And the implications, of course, are very significant for the Federal Reserve as it makes its monetary policy decisions. The next meeting of the Federal Reserve is the first week of November. Also, unfortunate timing for the President of the United States and Democrats in the election, if you assume, as I do, that the Fed is going to go another 75 basis points in increase, which would take the federal funds rate from 3 to 3.25 to 3.75 to 4. Now, the likelihood that that's going to happen is not just based on today's data, but the Federal Open Market Committee, which makes decisions for the Fed on interest rates, released its minutes from its September meeting, late September meeting, on Wednesday, and the clear message there was that they're having a harder time than they thought getting inflation under control. Mary, here's a quote. In light of the broad-based and unacceptably high level of inflation, the intermeeting news of higher than expected inflation and upside risks to the inflation outlook, participants remarked that purposefully moving to a restrictive policy stance in the near term was consistent with risk management considerations. What that means is they're going up some more. Mary.
Well, Paul, there's an expression, I think it was coined by Milton Friedman, that monetary policy acts with long and variable lags, which means that the Fed begins to act, but the actual results that they're aiming for come much later. And the other thing that's important for the politicians here is not only does the effect of their tightening lag, but it doesn't necessarily coincide with good economic news, because what the Fed's trying to do here is basically crush inflation by crushing demand. And if that's all you do, you crush demand, you are going to go into a recession. And you probably will go into the recession before you start to see the numbers that you want on inflation. And that means that you go through a very difficult period, as we talked about, of falling wage growth, no wage growth, or a loss in wages, along with a sluggish economy. And that is not a pretty picture for the politicians. Now, they could do something about it, which is work more on the supply side so that they can help alleviate the pressure on prices, but they're not doing that.
And when you say crush demand, what you mean is they are trying to crush consumer spending,
Exactly.
Crush business spending in the economy, which does so much to drive growth. And they're also looking at the mismatch between the number of job openings and the available supply of workers, and they're trying to narrow that gap. And of course, that will, as you say, have major implications for growth. Joe, you've been looking at what the Bank of England's been doing as it tries to cope with some financial fallout in its pension funds. They've been trying to raise rates to control inflation, which is well above 8% in the UK. But they've been caught with this financial fallout and the impact of rapidly rising rates on some financial vehicles, financial tricks that the pension funds had been using to increase their returns. And they're finding themselves now caught in a contradiction, having to tighten against inflation, but not having to buy bonds in order to make sure that there's no financial contagion and a big financial crisis. The Federal Reserve has been able to avoid that. And of course, unemployment is still very low in the United States. So that is wind at their back as they're considering increases. The political pressure against interest rate increases tends to increase as the job market gets worse. You see the Fed stopping on its appointed rounds here?
Yeah, I'm glad you bring up this situation that's going on in the UK with the problem that the British Central Bank, the Bank of England, is having dealing with emergencies that have suddenly popped up on the balance sheets of various pension funds. Because I think that this points to a big conceptual mistake that we might realize in retrospect that the Fed has made here. I mean, if you go back, months, and the way that Jerome Powell, the Fed chairman, and his colleagues have talked about what they were doing, this was all couched in terms of the labor market. You mentioned this issue of trying to reduce the number of job vacancies in the economy to bring inflation under control. There's been this issue of the Fed will stand pat on fighting inflation even if unemployment starts to tick up a little bit. I increasingly worry that that's going to be a bit of a distraction, that the real problem that central banks everywhere are going to have is that we've had this period really going back to 2008 of extraordinarily loose monetary policy, which has created a lot of distortions in the economy, a lot of debt in the economy, the nature of which we don't necessarily understand. We don't understand how various, investors and debt products might be connected to each other. What's going on with the UK pension funds right now, which came under stress as hedging strategies went awry amid rising interest rates, is that we've discovered that the financial risk for monetary tightening might be much greater than the labor market risk. And so the real needle that the Fed and others are going to have to thread will be, how can you somehow steer monetary policy back to a more normal level of interest rates? How can you undo all of the extraordinary quantitative easing that they've done over the past 15 years without triggering a financial crisis of some sort that would have much worse effects on the labor market and everything else than they have thought their policies would have directly?
Well, the other implication of the consequences of these numbers today is, of course, political. And we have an election coming up, you may have noticed. And inflation is widely cited by Americans as the number one issue, the cost of living, the number one issue. And so this report today is obviously being jumped on by Republicans to make the case against Democratic governance. And I think the most important point they're making is that there's a link between what they passed in law, and particularly the March 21 so-called COVID relief bill, the $1.9 trillion package, which many of us warned would be inflationary, and the link between that and the numbers we're seeing today. And of course, all Republicans can say they voted against that bill because they did. Democrats understand their vulnerability. Even if they don't accept that there was a link, they went ahead and passed something called the Inflation Reduction Act, Mary, not too long ago, which tried to suggest that it would control inflation. I think, in fact, it was an increase in spending. The first reduction in inflation, in actual inflation from it in terms of reduced spending, didn't come till 2027, a long time from now. So politically, not good news for the Democrats.
Yeah, I mean, I think that if you look at the history of monetary crises over the decades, you will find that in 9 out of 10 cases, if not all of them, the central bank begins financing the government. That's why we like to say that the central bank is independent of the government, so that relationship is cut. But what's been going on here with the Fed is not just that the politicians can't stop spending money, but the Fed was financing that at very low rates for too long. And now the fruit of that bad policy is coming to bear in higher and persistent inflation from all this government debt, which was financed by the Fed.
Joe, all of this leads to some pessimism on the part of business and CEOs. Predictions coming out of the Business Council CEOs, which is the big shot CEOs, the biggest companies. I think about 100% of them are now predicting that there's going to be a downturn of some sort. Jamie Dimon, the head of JP Morgan, made headlines when he said that there were going to be probably a recession in something like 2023 or 2024. And President Biden was asked about it. He said, well, if we have one, it'll only be shallow. Perhaps he'll be right. But we're in for some heavy weather ahead economically, aren't we? And of course, we don't know how that will play politically. But my bet would be that these numbers and what people see at their stores when they go in and buy goods is going to be the biggest single factor in the election. Last word, Joe.
Yeah, I think that there's quite a lot to that. And it's important to remember here that, the inflation data that we're talking about can be a useful sort of benchmark of what's going on out there. But at the end of the day, voters go into that polling place as Marxists, Chico Marxists. Who are you going to believe, the data or your own lying eyes? People know what they are spending in their own households for things like gas or heating oil for the house or food or any of the other things that they want to spend on. They know what's happening with their paychecks. And I think that that is going to end up being more important than any of the data that are coming out about the CPI stuff, which it gives journalists and politicians a useful guide about what's going on, but isn't necessarily the last word or the truest word about what voters have on their minds economically as they're going to vote in the next couple of weeks.
All right, we shall see about 25 days or so, 26 days before the election. So thank you, Joe. Thank you, Mary. Thank you all for listening. You can email us, our valuable listeners, questions at pwpodcast@wsj.com. And if you like the show, please do hit that subscribe button. Wall Street Journal subscribers can also join Kim and Karl Rove and yours truly for a live opinion event. Can Republicans retake Congress? On Monday, October 17th at 7 p.m. That will be live in Dallas or streamed online. And for more information, go to wsjplus.com/opinion live for tickets and more information. And as always, we will be back here tomorrow for another edition of Potomac Watch.